Markets are sending mixed signals right now. The jobs market looks kind of weak, unemployment is rising, and gold is hitting new all-time highs. Yet, investors are betting big on interest rate cuts. That tension has everyone asking the same question. Is this the start of a crypto rally or a warning sign of something much bigger? My name is Danilo, and today we're breaking down exactly what's going on. We'll look at the cracks forming in the global economy, the tailwinds pushing risk assets higher, and what all this really means for crypto. If that sounds interesting to you, make sure to hit that subscribe button and ring notification bell so you never miss future crypto updates. Alright, let's get into it. The first place to look is the jobs market, and to be honest, the numbers aren't so great. In August, the US added just 22,000 jobs. Economists were expecting around 75,000, so this was a big miss. On top of that, the unemployment rate has ticked up to 4.3%, and revisions to earlier jobs reports revealed that June actually showed job losses after adjustments. That tells us the labor market isn't just slowing, it's getting quietly weaker in the background. Those cracks show up in the bond market too. The 10-year treasury yield has fallen to its lowest point in 5 months, and the 2-year yield is sliding as well. Normally, when yields drop this quickly, it means investors are running into bonds for safety. It's basically Wall Street just saying, we don't like what we see ahead. But not everyone is convinced this reaction is healthy. Some analysts are warning that the bond market may actually be too complacent about inflation and fiscal risks, which adds yet another layer of uncertainty. The US dollar is also under pressure. The dollar index has dropped more than 10% this year, one of the steepest declines in decades. A weaker dollar often pushes global investors to look for the alternatives, and that's historically been good for Bitcoin. Still, when a currency as central as the dollar weakens this quickly, it's also a sign that confidence in the broader economy is slipping. And it's not just the traditional markets flashing signals. Crypto ETFs have been showing consistent outflows, with hundreds of millions leaving both Bitcoin and Ethereum funds in recent weeks. It suggests that big money is being cautious, even as retail investors look for opportunities. So, when you put all these factors together, the weak jobs, falling yields, a softer dollar, and ETF outflows, it does paint a picture of fragility. On the surface, this all looks bearish, but here's the paradox. The very same conditions that make markets nervous are also the ones setting up a potential bullish shift for crypto. For all the bad headlines, there's also another side to this story. The slowdown in jobs and the drop in yields have traders betting that rate cuts are coming fast. Big banks like Goldman Sachs, Bank of America, and Citigroup are all forecasting multiple cuts in 2025. Futures markets are already pricing in a strong chance of a cut as early as September, and some traders are even betting on a half move point. You might be asking, but why does this matter? Rate cuts are basically fresh oxygen for risk assets. When borrowing gets cheaper and liquidity expands, investors start looking for higher returns. Stocks benefit, but crypto often benefits even more because it sits at the far end of the risk curve. Lower yields also mean less incentive to sit on cash or bonds, which pushes more money into alternatives like Bitcoin and Ethereum. We're also seeing signs that institutions aren't standing still. Sora Ventures recently announced a $1 billion Bitcoin treasury fund designed to help Asian companies diversify their reserves of digital assets. Regulators, meanwhile, are exploring ways to bring 24/7 markets into the mainstream, something crypto has been doing for years. These aren't just technical shifts, they're signals that traditional finance is looking for ways to merge with the crypto ecosystem. And hey, Ethereum is yet another bright spot. Even as ETFs show outflows, on-chain data tells a different story. Transactions on the network have jumped more than 30% over the past month, and total value locked is approaching 100 billion. That means users are still active and capital is still flowing into the protocols. It's a reminder that while short-term traders might be pulling money out, the underlying activity in crypto isn't slowing down. Put together, this is the paradox. Weak data is fueling nervousness, but it's also laying the foundation for looser policy and more liquidity. And history shows that when liquidity returns, crypto tends to move first. The big question is, if all these tailwinds are lining up, why hasn't crypto broken out yet? I'm not gonna lie, this is where things get a little complicated. On one hand, the bearish case is quite clear. The labor market is softening, ETF flows are negative, and traders in the derivatives market are showing hesitation. Ethereum futures premiums have dropped below the neutral 5% threshold, and option sentiment suggests investors aren't ready to go all in on a rally. That hesitation matters because it shows professional traders are still protecting against downside rather than betting on a breakout. But the bullish case is just as strong. Liquidity is expanding, on-chain activity across Ethereum remains robust, and institutional adoption keeps inching forward. $1 billion Bitcoin treasury fund and regulatory experiments with 24/7 markets aren't just headlines. They're the kind of long-term structural changes that could drive the next wave of adoption. The tension shows up most clearly when you compare gold and Bitcoin. Gold has been hitting fresh all-time highs, fueled by falling yields and a weaker dollar. Bitcoin, on the other hand, has struggled to hold momentum, even giving back gains after the weak payrolls report. Both assets should benefit from the same macro setup, but one is breaking out while the other is stalling. The question is whether Bitcoin eventually plays catch-up, or if capital keeps flowing towards the safety of metals. There's also the third angle, stagflation risk. Some economists warn that slowing growth combined with sticky inflation could trap policymakers in a corner. If that happens, rate cuts might come slower than markets hope, and the liquidity boost everyone is waiting for could be delayed. That scenario would keep pressure on risk assets, including crypto. So right now, we're kind of in a tug-of-war scenario. Bears point to weak data and outflows, while bulls highlight liquidity, adoption, and structural growth. Both sides have a case, and whichever breaks first will likely determine the next big move for crypto. Short-term market swings are important, but the bigger story is how the foundations of crypto are evolving. In the US, regulators are moving towards more coordination. The SEC and the CFTC have both signaled interest in harmonizing rules, and the Federal Reserve is preparing to host a payments innovation conference that includes topics like DeFi, stablecoins, and tokenized finance. This actually matters because one of the biggest barriers to institutional adoption has always been regulatory uncertainty. Clear rules won't remove all the risk, but they lower the friction for large players to get involved. At the same time, institutions are testing new ways to integrate crypto into their balance sheets. The launch of $1 billion Bitcoin treasury fund in Asia is just one example of how traditional finance is starting to treat Bitcoin less like a speculative trade and more like a strategic reserve asset. It is quite early, but these kinds of moves could create a playbook for other corporations and funds to follow. Stablecoins are another critical piece of this story. They act as the settlement layer for much of the crypto economy, but they're also drawing scrutiny. A Nobel Prize-winning economist recently warned that poorly backed stablecoins could eventually create systemic risks, even leading to taxpayer bailouts. Meanwhile, new legislation like the Genius Act is trying to build a federal framework, but loopholes remain around issues like interest-bearing features. These debates might feel far from day-to-day trading, but they do matter. If stablecoins fail, crypto's core plumbing comes under stress. If they succeed under clear rules, they could become one of the biggest on-ramps for global capital into the digital asset world. So, when we step back, the picture isn't just about near-term price moves. It's about a system that's slowly maturing, with regulators, institutions, and infrastructure all moving towards mainstream integration. The path won't really be smooth, but the direction is becoming clearer. So, what does all this mean in practice for you? Let's break it down. For traders, the key signals to watch aren't just Bitcoin charts. Bond yields and the US dollar are leading indicators of risk appetite. When yields fall and the dollar weakens, it usually sets the stage for risk assets to rally. Combine that with the odds of rate cuts, and you have conditions that can spark big moves. But there is a catch. Historically, the first reaction to a rate cut cycle is often volatile. Rallies come quickly, but pullbacks can be just as sharp. That means the edge goes to traders who position early but stay disciplined with risk management. For builders, the story is about timing. Regulatory harmonization between the SEC and CFTC is creating a clearer environment, and new conferences and statements from the Fed show that decentralized finance and tokenization are no longer niche experiments. They're moving into the mainstream agenda. That opens doors for partnerships, funding, and adoption that weren't really realistic just a few years ago. The key is to stay plugged into policy changes, because they're likely to create windows of opportunity for projects ready to scale. For long-term holders, history gives us a simple lesson. Rate cut cycles have consistently been followed by strong rallies in risk assets, and crypto has often led the way. But patience is essential. Early volatility, ETF outflows, and bearish narratives can all shake conviction before the liquidity effect fully kicks in. The lesson here is that asymmetric upside does still exist, but you need to survive the noise to capture it. So whether you're trading the short term, building the next big protocol, or stacking for the long run, the takeaway is the same. This environment is full of both risks and opportunities. Understanding the signals, jobs, bonds, the dollar, and regulation helps you separate noise from real momentum. We started this video with a simple question: should you worry about the cracks in the economy or lean into the tailwinds building for crypto? The answer is actually both. Weak jobs data, falling bond yields, and ETF outflows all highlight real risks that markets can't ignore. But at the same time, the probability of rate cuts, a weaker dollar, and stronger on-chain activity are setting the stage for renewed momentum. That's the push and pull we're living through right now. The short term may stay choppy, but the bigger picture points towards more liquidity and deeper adoption of digital assets. The challenge is staying patient and prepared so that you're ready when the tide shifts. But hey, let me know down in the comments. Are you leaning cautious or are you positioning for the next rally? If you found this breakdown helpful, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Thanks for watching, and I'll see you in the next one.